Bear from RJO, Monday afternoon, last Monday of the year, last week of the year. All right, the bonds. We're up a little bit on some weak China data overnight that has stocks limping a bit to start the week and a bid for the treasuries. Brings us right up to where 100-day moving average, 155.27. That kind of says it all. We've been in a situation with characterized by a lot of balance lately. Yields have been in a tight range on the long end, especially. This is regardless of the Fed beginning their tightening cycle, regardless of flight to quality out of some junk bonds, especially oil patch junk bonds, regardless flight to quality out of Puerto Rico. There doesn't seem to be the impetus to push lower than roughly 285, 290, or push higher than 310, 315. The extremes for the year actually were outside of that. Of course, back in February we hit the lows, 226. Back in end of June, I think it was, early July, we hit the highs, 327. And things have been basically pretty stagnant since. Yellen seems to be pretty sure inflation is coming back and therefore has begun this tightening process on the very short end of the curve that she can control. However, the market seems to be less sure that any inflation is going to come back. But obviously, the market's got its eye on the oil patch, was a disaster. These things these cycles, when they turn, tend to last for long periods of time. Most of the price damage is done in the first few years. So oil may stabilize here, but it's certainly not going to be a problem for the consumer price-wise going forward, or make anybody scared about inflation, and therefore, the market looks at value in the long bond at roughly these levels, regardless of the Fed tightens again or even again after that. Okay, and also I should mention, the 10-year, of course, is lower than the 30-year. It's trading around 222, but that's significantly higher than its German counterpart, which is way down at 0.62. So there is some value there. All right, what's going to keep these notes and bonds from going higher? There's value buyers, but there's not buyers on rallies. In fact, there appears to be some sellers, major sellers on strong rallies. The sovereign pools of money from basically oil patch countries, the Saudi Arabians, Norway, etc. They've been sellers of treasuries on bounces, basically to cover gaps in their budgets that have developed due to lower revenues going forward. So it's a bit of a stalemate. I guess I'm saying right here that's likely to continue this week. To end of the year, the data is light. There's consumer confidence number tomorrow. There's a Chinese PMI. Probably the big deal of the week, Wednesday night, so that will affect things Thursday morning, the last day of the trading year, when you come in. Kind of a tug of war between weak manufacturing on a worldwide basis due to the downshift in the oil patch and better balance sheets by the consumers. I think the big question for 2016, will the consumers finally spend some of this kind of oil dividend money that they're saving at the gas tank, they're saving heating their house, et cetera, et cetera. Will that be enough to keep some growth to the U.S. economy and some growth to the world economy, regardless of the pull down in commodities in general? I mean, if that's the case, maybe we do have a chance to push through 3 1/4 yields and the bonds to break a little bit. In the second half of the year, I don't think there'll be any change in the first quarter, but we'll have to see. That's it. Hope everybody had a good 2015, and I wish everybody well in 2016. Thank you. Futures and options on futures may involve substantial risk and may not be suitable for all investors.